Whenever it comes time to borrow money for a house or a car, you're going to be interested in how much it's going to cost you to borrow it. In the case of a house, you might also be seeing how much the amount of money you can spend is going to allow you to borrow for your house. This is a simple loan calculator that we can use to calculate how much we're going to pay on a loan. So I'm going to assume that we're borrowing for a house in this situation, and I'm going to say that we're going to borrow $200,000. The current interest rates are around 6%, so let's test it with 6%. The term in years is how long you're going to be paying the loan for, and let's assume you're going for a 25-year mortgage. So now we're going to look at the amount to pay, and the calculation for this is what's called a PMT function. You'll type equals PMT and then an open bracket. The first thing we're looking at is the rate, which is 6%. But we can't just put 6% in here because the calculations are going to be made on a mortgage for every time that you make a payment, and we're going to be paying 12 months of the year. So we need to divide the interest rate by 12. That's the 12 payments we're going to be making a year. Unfortunately, Excel doesn't make this clear, and this can be a little bit confusing. We're about to encounter the next confusing bit, because N per is the number of payments or the number of periods of the loan. Well, we're going to be paying for 25 years, but we're going to be making 12 payments every single year. So we need to multiply by 12 in this instance. And then I'll add a comma, and then we need the present value. Well, the present value is just how much are we borrowing. So let's click here on this cell. The last two elements of this formula are optional. They're in a square bracket here. Future value is simply how much is going to be left over at the end of the loan if we make all our payments. Well, typically on a mortgage, that's going to be 0, and it's assumed to be 0 if we don't put anything different. And type just indicates whether we're going to be making the payment at the beginning or end of the period. It's significant a little bit, but we're just going to ignore it because it's not going to make a big difference to these calculations, because these calculations are approximate. I mean, they're good calculations, but they could be dollars out. So I'm just going to add my close bracket and just press enter. Now we've got a negative value here. We've got negative $1,288.60. Well, the actual amount we're going to pay out each month is $1,288.60. And because we're paying it out, Excel says, well, that's a negative value. But you know what? I like to see that in terms of positive numbers. So I'm going in front of the PMT calculation here. I'm just going to add a minus symbol. And now we get a positive value. This is what I'm going to be paying out. I'm not silly enough to think that the bank's going to pay me $1,288.60 for simply borrowing this money every month. So once we've done this, we can use this calculator to do other things. We could say, okay, well, what if we wanted to borrow $225,000? What's that going to do? We just type in a new value and we can see what our payments are going to be. Or if the interest rate goes down to 5.75%, let's type that in and let's see how that's going to affect our payments. Or if we take out our loan for 30 years, for example, how's that going to affect our loan? Now, the other thing that's interesting is how much you're actually going to pay for this money. So let's go and have a look at the total amount paid. So in this cell, we're going to type an equal sign, and we're going to be paying this much a month. So let's multiply this by 12, which is going to be for a year, and then multiply it again by the 30 years. And this is the amount that we're going to be paying for the life of the loan. So at the end of the loan, if we continue with these payments, these values, then at the end we're going to have paid somewhere in the region of $472,000. A lot of that, of course, is interest. So let's calculate the interest. Equals, we're going to take the amount that we're going to pay over the full life of the loan, and we're going to subtract from that the amount that is in that value that is the actual amount that we borrowed in the first place, because everything else is interest. And so we're going to have paid $247,000 or more in interest, which is obviously greater than the amount that we borrowed. So just an interesting calculation to make. Now, these values aren't exact, but they're a good approximation. They're a sound approximation to allow you to make the calculations and determine whether you can afford to borrow money. Now, the other thing you might say is, oh, you know what? I could pay $1,500 a month. So how much more would I be able to borrow if I could pay $1,500 a month? Well, let's go to the Data tab and let's go to What If Analysis and Goal Seek, because that will allow us to make this calculation. So what we want to do is to set this cell here to $1,500 because that's what we can pay. But we want to see how that is going to impact the amount we can borrow. So let's click on here and we'll click OK. Well, if we could afford $1,500 a month, we could borrow closer to $257,000. Again, not exact, but close. But let's say, in actual fact, we don't want to do that. What we want to do is to continue to borrow our $225,000. But if we could pay $1,500 a month, how would that affect the term of our mortgage? So let's go to our What If analysis and go to Goal Seek. We're going back to this cell here. Again, we're going to set it to the $1,500 a month that we've determined we could pay. And let's, in this case, change this cell. So if we pay $1,500 a month, how long is the term in years going to be? And it's going to be shorter, obviously, than the 30 years. Well, you know, we could bring that down to 22 years and look and see what it's done to the interest. We're going to be paying a lot less over the life of the loan, but we're also going to be paying less interest than principal in this situation. So this Goal Seek and this loan calculator are really handy ways of analyzing the amount that you can afford to borrow and the kind of payments that you're going to have over the life of your loan. The worksheet is, of course, very simple to set up in Excel as well. But you know what I suggest if you're going to do a worksheet like that? Use my values for the first set of values that you put in. Make sure that your formula is working correctly and then go and experiment with your own values. It's really important that you don't rely on something like loan payment calculators if you haven't got your formulas correct, and checking it against some known data is a really good place to start. If you like carefully researched content like this, clearly presented in a step-by-step format so that you can get great results every time, then you'll love my other YouTube videos. So give this video a thumbs up and click to subscribe to the channel. And on the screen now, you'll see a video that I've handpicked for you to watch next.